want to address something that is not so much directly tagged with, say, religious freedom per se, but is nonetheless, it's dealing with something that's going to impact millions of people across the country in very deep financial ways, and not just themselves, but also their children, their grandchildren. To talk with us about this new edict, if you will, by the federal government, we have with us here in studio CPA Phil Liberatore. Thank you, Phil, for joining us.
Thank you, Brad, for having us today.
Now, Phil, you're a very highly respected CPA, an accountant. You watch and monitor very closely what's going on with the Internal Revenue Service and the shenanigans they push on people and how people should deal with it. So we're going to talk about a real problem that's come up as of January 1st. And then we're also going to talk, though, about what people can do about it. So if people are getting discouraged right up front, I don't want them to turn off this program. I want them to keep listening.
Yes.
Because we have something very constructive that can help them get out of this. But first, tell us what happened that is going to impact so many when it comes to their IRAs and the money that they're setting aside, seemingly safe from taxation.
Well, what happened, Brad? Inherited IRAs just got complicated. On December 20th last year, President Trump signed into the Secure Act. It's a far-reaching bill that includes significant provisions and a major provision for older Americans. And here's what it is, Brad. The bill's passage is Congress' acknowledgement there's trouble brewing in the U.S. retirement system, which requires most workers to supplement Social Security with personal savings. Now listen to this, Brad. This is really critical. According to data from the U.S. Bureau of Labor Statistics, published in 2018, only 55% of the adult population participate in a workplace retirement plan. Only 55%.
Oh, wow. Okay, so there's a lot of people just simply relying on Social Security, and this new law is supposed to help them, to encourage them to be more prepared, but yet that's not what we're really talking about. There's some problems with it. In addition to the benefits, there's some problems that people aren't aware of.
Well, the key to this whole Secure Act is they don't want IRA holders to use it for inheritance. In other words, they want them to outlive their retirement. And the whole key issue here is that you can't stretch out your IRA strategy any longer. You've got to take your IRA within 10 years. And they upped the limit when you could start taking it from 70 and a half to 72 years of age.
Okay. I want to make sure I've got this. Okay,
yes.
Because many people are hearing you right now. They're thinking, okay, wait a minute. I must have misheard what was just said, because what you said is this new law will require people to basically drain their IRA in 10 years.
Yes.
Okay, because the IRA is there to take care of us throughout our retirement. And it's particularly important in the latter years of our retirement because that's often when we have more costs and more expenses, like medical, et cetera. But this is basically saying, no, we want you to drain it. So let's say someone starts their retirement at 65. That means they have to drain their IRA by the age of 75. What happens if they don't?
Well, what happens is they get penalized, and we could work around that, Brad. But the whole idea of this Secure Act is they don't want this IRA to be passed on as an inheritance. They want the American taxpayer to use their IRA while they're still living.
Okay, why? What's the rationale behind that?
Well, they don't. It wasn't. The IRA was implemented for retirement. So what they're seeing is a lot of the retirees are just not taking as much as they can and passing it on as an inheritance, and that's not what it was intended for. That's the whole issue here.
Yeah, I think that's a great thing.
Yeah.
It's a great thing for people, particularly for people who want to both prepare for retirement and then at the end of the day, hopefully have something for their kids that may be the only assets that they have to leave their kids. I see nothing wrong with that, but the bottom line is the government, at the end of the day, they want to tax that revenue either one way or the other, either by individuals taking money out and spending it, or at the end of the day, just taxing it and preventing it from going to the kids and the grandkids. How much revenue are we talking about here that the government is planning on collecting?
Well, here's the key. according to the Joint Committee on Taxation, they're figuring that this is going to generate over $15 billion in additional tax revenue over the next 10 years, Brad.
15, okay. So,
$15 billion would it be?
Wow.
In tax revenue.
Okay, because people are not going to drain it the way they're supposed to over 10 years, and it's a real problem. I know many people in their trusts, as I understand it, have it worded and positioned in a way so that the money at the end is dispersed, or it's given out in a certain way. That's not going to coincide with this mandate, the way that their trust is set up, which may implicitly result in heavy taxation.
Well, the beneficiary now, whoever the beneficiary of the IRA, if they decease, they have 10 years to take it out as well. So they can't keep draining this IRA until ever. I mean, it's a 10-year limit now on these inherited IRAs.
And so they're going to, if it's a large amount in IRAs, I know, for example, Senator Mitt Romney, he knew how to use IRAs incredibly, using options and putting money in, putting money out. The guy, with his shell things around, and he's just put hundreds of millions or millions and millions of dollars into this IRA that he's using in a creative way to preserve his assets and his estate for his whatever. When I see the kind of shenanigans put on by Senator Romney, I get it. I can sort of see why they're cynical when they look at how someone is taking advantage of the system in a very grotesque way, divergent from what it was intended for. I get that. Yet, we're talking here, though, about moms and dads, regular Americans, that are going to be impacted, and their kids who are going to be forced to have to liquidate it in a shorter period of time, which means they're going to have to pay taxes on it. If they could stretch it out, their tax rate wouldn't increase. It wouldn't be the tax bracket won't increase. They won't be paying out as much in taxes. So this is I see it as an attempt by government to increase taxes. Of course, it started in the House and then passed by the Senate, signed into law. Phil, what can people do? What should they do in view of this change? Okay,
there's four things they could do, Brad. Number one, they could take the hit now on the traditional IRA and convert it to a Roth IRA. Now, as you know, the Roth IRA earns money tax-free, and it's tax-free when you withdraw it. But if you convert it, you pay the tax up front. So that's definitely one consideration that someone can do, is just convert it to a Roth IRA right now.
Okay. Why would someone not want to do that?
Well, they have to pay all the tax upon conversion. So there's the hit there. They take the hit initially, but after that, they're home free.
After that, they're home free. Okay. Yeah. And that can make some really good sense, particularly if their tax bracket right now is not necessarily high. They can make that conversion. They can make that conversion over several years, perhaps?
They could do it in increments, as well.
Okay.
Or one time.
Okay.
Exactly.
Okay, that's a definite, potentially viable option for a lot of people. What's another one?
A second option, and this is good for Pacific Justice Institute, Brad. They could contribute up to $100,000 of the IRA to charitable contributions. In other words, they could give up to $100,000 of their IRA in 1 year to charity. And that includes Pacific Justice Institute, who's doing a great work all around the country, Brad.
Okay. Phil, you're a great friend. I didn't ask you to say that.
No, I just came to mind right now as I was thinking about this charitable contribution.
Well, I greatly appreciate that recommendation, no matter how people are led to give. Obviously, Pacific Justice, we greatly appreciate people's support. But I think that's definitely empowering, because there's a lot of people at the end of the day are going to want to give a part of their estate to charities. And we at Pacific Justice actually even have attorneys that we recommend that can make those arrangements as a part of their trust and their will, et cetera. But this is something they can do now that could be very effective, very impacting in the present, and yet have some definite tax savings, if you will, in view of this new law. So
see, for number one, they're not taxed on the IRA. for the up to $100,000, and number two, they get a charitable contribution deduction.
Okay, so it's a double benefit.
It's a double benefit, Brad.
Okay,
to do it to give it to charity.
Okay, that's very significant.
Up to $100,000.
Okay, that's really significant.
Per year,
okay.
$100,000 per year.
Oh, per year. Okay.
Yeah.
Okay, this is really good. We have two more options, real quickly. What are those?
The third option is make your spouse the heir to the IRA. That way, when she gets the IRA, she's got another 10 years before she has to take it out. So it stretches it out even further.
Okay, so make your surviving spouse the heir of the IRA instead of the kids.
Instead of the kids.
Okay, that's good. It draws it out.
And then she could pass it on to the kids when she passes. So this is stretching it out even further.
Okay, good. That's very valuable, and that's something that they should definitely talk to their attorney about. And once again, if people need counsel on an excellent wills, trust, estates attorney, we have a number of them that we can refer to them wholeheartedly. What's the final thing that they can do?
The final thing is look into life insurance. IRA account distributions can be withdrawn to pay life insurance premiums. So in other words, you could take the proceeds from the IRA and pay it directly into a premium into life insurance, and then the owner of the life insurance, it's tax-free upon the death of the person that's got the life insurance.
Do they pay tax on the money that they're taking out of the IRA, though, to put into life insurance? Is there a taxing?
There's a small tax, yeah.
A small tax, but
yeah.
But this is an incredible way of greatly expanding the net impact on their estate and who they want to benefit, whether it's a charity or whether it's their loved ones or family members. That's another great point. Phil, real quickly, where should people go if they want more information about how they can really protect themselves regarding this new taxation threat?
Well, they can contact us at phil@liberatorecpa.com or stopirspain.com, and we'll get them more information out to them right away, Brad.
Okay, very good. I like that. stopirspain.com.
Or they can call us directly at 877-6-SOLVER. That's 877-6-SOLVER.
876-SOLVER. Very good.
I'm the IRS Problem Solver, Brad, so I'm here to help everybody.
I know, and that is your nickname.
Yes.
And I'd say you're probably the most well-known CPA problem solver in Southern California. So keep up the great work, Phil, and thank you for being on the program.
Thank you, Brad. Keep up the good work on religious freedoms and liberties. God bless you.
Thank you.